Hello, Oracles! Today I want to share with you guys my panic-proof portfolio. So again, this is something I discussed last week that I wanted to go over with all of you. All the changes I've made over the last 6 months in my absence, my change of focus that I've had going on. Still obviously love Tesla long term, but I think we've got some opportunities in the near term. And again, everybody has to do what's right for their own portfolio. So for me, this is what I found is right for me, my particular situation, my portfolio, and how I want to do things with my investing going forward. So today I'm going to break down all of the different things I've done in my portfolio, all the different categories that I have, what my plan is for the future. I've set up a whole entire end game goal for it. And of course, there's always tweaking along the way. I just made some changes this past week into it as well. So again, when it comes to investing, sometimes doing less is more. But for me, I set up an end game and I just do those little tweaks along the way because you don't want to do nothing along the way. Things change in the market. There's always different things that happen. So it's good to do some changes and just at least pay attention. But a lot of times doing less is more. And for me, when it comes to investing, spending less time in the market to be able to make as much money as possible and get this cash flow coming in is what I'm looking for, because I don't want to be trading time for money when it comes to a job. I don't want to be trading time for money when it comes to investing either. I want to live my life. Some people enjoy investing. Some people love swing trading. My dad is one of them, but he also loves living his life also. So for him, it's something he does that's fun. For me, I'm sure I would enjoy it, but I have a full-time job. I don't want to be doing swing trading on top of a full-time job also. So I'm trying to do something with my portfolio that's going to take me from a place where I'm trading time for money, where I'm trading money for money and just having money coming in passively. This is why I've changed my focus over to dividends. And full disclosure, before we get into this, none of this is financial advice. Everyone has different particular needs for their own portfolio, as I had mentioned. Everybody has different particular needs when it comes to their own personal finances. So this is only for entertainment purposes. And for me, this is what I'm doing for my portfolio, what is best for me. And if you can learn something from it, that's awesome, and take some value away from it, that's great. But again, not financial advice. All right, so in my portfolio, I have broken it down by several different categories. These are extreme high yield dividend plays. Then I've got some stable income dividend plays here. I've got my long-term growth ETFs and dividends that I can get in from these. These are individual stocks. These are dividend growth stocks that I have going forward here. Flynn, I'll go into in detail in another video, but that is the only one that is an actual ETF in this whole category. Then I have growth plays that I want to see long term that do not pay dividends. So Google, Uber, Tesla, I'll dive into that in a moment. And then I have a couple of swing trading plays that I'm doing with SQQQ, SOXS, and I'll be adding more to this as well. Sort of a swing trade type thing. And again, I don't want to be trading time for money, but if there's some opportunities I see that I can swing and make some profits to be able to add more money to the rest of my portfolio, I will add those in this category here. And then I have the full breakdown below, which I will go into also. So going back to the top here, starting it all off, these are my high yield plays. Now, all the way to the right in this spreadsheet, and this spreadsheet is something I do share with my patrons on a weekly basis, and I'll get it over to my members as well. Thank you all for your patience as I've updated all of this. I actually want to get this to a point where I can share it with you guys so that you can download it and use it for yourself, because it's not just my portfolio here. Looking down below, I've got my entire spreadsheet built out for all of my finances, my own personal P&L, my detailed expense reports. My entire net worth is on here, budget for the year. So everything is here all in one place. And I want to be able to share this with you guys so you can use it for yourselves. But in the meantime, I'm just going to be sharing with you guys what I have. And if you can get some benefit out of it, that's great. So I've set up an end game goal for all of my positions here. And my end game for all of my high yield plays is 50 shares each, which I'm over that. I've actually been trimming down on that. Then I've got all of the different shares, and it's different quantities, and it's sort of based on dollar amounts because I'm just at this point looking to have equal weighting in everything. So I'll go over with you guys what my little games that I play with myself to build up this portfolio are at the moment. But I've got the whole entire end game. And this is something I learned when it comes to like video games. When I played video games, I liked Final Fantasy games, role-playing games, is what do I want my character to be at the end game? How do I get to that end game? And that's really it is, if you realize what you want to do at the end of the game, what tasks do you need to accomplish along the way to achieve those goals? And how quickly can you get to those goals? Like my dad teaches me when it comes to golf is you play the hole backwards. You're like, all right, well, I want to get into the hole. Well, before that, I need to get this shot and then this shot. So my first shot needs to go to this specific distance in this specific place to get to the hole in the most efficient manner. So that's how I'm doing this as well is, all right, well, I want to have a portfolio that's going to be generating enough income coming in that I can live off of. And I don't want to have just income coming in that's going to, just basically meet my basic needs. I want to have more than that. I want to have it continually growing so that I can live more free as time goes on. And it's something I can pass on to my son so that he can take on that as well. So this is going to have multiple different categories where I have a lot of income coming in now to be able to feed those other categories that are going to be growing over time. And so for me, that's why I set up that whole entire end game. And so my whole entire end game portfolio for everything is around $2 million that I need to get to. And currently right now I'm at about 64,000. So long way to go. I'm at 3.3% of my way to that goal, but this is just how I'm tracking it. I know this is not going to be an overnight thing. This is something where you need to be doing it on a regular basis, sort of like health and fitness. You're not going to be able to lose 10, 15 pounds overnight unless you cut off a limb. So you're going to need to go out there and do the same thing over and over again, basic, boring routines, but you're going to see those results in the long run. Same when it comes to this type of investing. Now, with that investing, coming over here to where I broke it down, my goal is to have passive income coming in of $105,000 every single year. That's $6,200 a month. So if I can achieve all of this, obviously I can live relatively easily as long as inflation stays the way it is or goes down and doesn't skyrocket more. I will be able to, outpace inflation at the rate that the Fed is looking to get it to and live myself a comfortable life. And this, of course, is just where it's at right now. With all of the dividends that could be growing from all of these positions, this number will go up over time. And the goal of this portfolio is to make sure that the dividend payments that are coming in are growing faster than inflation, sort of like getting a raise at your job. You want to make sure that the raise that you're getting at your job is higher than inflation so that this way you can outpace that and continue to get ahead. Because if you're not getting a raise that's more than inflation, you're actually losing money. So if I do plan on stepping away from my job, I want to make sure that my income source is also growing at a pace that is faster than inflation. And I apologize, I looked at the wrong line. It's $8,800 a month that I would have coming in. So it's $8,800 a month coming in. I'm currently at $6,200 annually for the year and at $522 monthly. So breaking down my entire portfolio here, again, I have CONY, which has done very, very well for me, especially with this Bitcoin and crypto boom that has been going on recently. I have 75 shares of QQQY, which has done relatively well for me, but I want to thin that position out because if I do feel like we're going to be getting a big pullback in the market, this one could underperform. So while the income coming in would be nice to offset some of the dip, I just want to make sure that I'm not going to put myself at too much of a risk. TSLY has been not great for me. I have not been doing well. It has been dropping. I've had it for about a year now. And while it was great in the beginning, at some point when Tesla started to pull back significantly, so did TSLY. A lot of people decided to short it. So overall, it was a learning experience. I mean, my total return on it is I'm upside down 15%. So not great on that one. If I'd gotten out, if I'd gotten out in the September timeframe, I was way up, way up on this. So it could come down to a timing thing. So I'm not going to say that TSLY is terrible overall. It's just these here are going to require a bit of timing on it. So CONY is another one where if we see a massive pullback in the entire cryptocurrency market and Coinbase drops, this could pull down in the same fashion that TSLY did. So it's just something to monitor and pay attention to. KLIP I have, JEPY, and YMAX. And YMAX I decided to add to my portfolio because this includes all of the different high yield plays that they have in their portfolio themselves. So at some point, some swing up, some swing down. So this could balance out and create a relatively decent cash flow generation that's a lot less volatile than the rest of them, let's say. So I chose to go into this one, just kind of test it out and see how it's going to go. So now my stable income plays that I've got here, I've got SVOL, SPYI, AGGH, high, and you guys can pause this and take a look at it. A lot of these are different ETFs that play different pieces of the market itself. And some are covered call income plays. I have ARCC, which is a BDC. That's a business development center. So these are places that are going to be loaning out money to smaller companies. I've got TLTW. This is plays covered calls off of TLT, Hercules Capital, Hess Midstream. I do like these energy plays that are out there. Some of them require a K1 form when you're doing your taxes. HESM, Hess Midstream, does not. So that's why I have this one in here. I just didn't want to deal with the K1 form personally. JEPQ and JEPI, these are two that I'm sure many of you have heard of. These are very popular covered call ETFs that are out there. Maine is another BDC. And then I've got my REITs. Uh, I've got O, which is Realty Income, Vici Properties, and PLD. These are my three REITs that I really like going long term. Vici, we've been seeing what's going on in Las Vegas. The city's booming again. It's not like it ever stopped, but there was a time there were kind of hit a lull, and they've got sports teams that are going over there. The strip is building up. It's constantly busy. I know a lot of people in Vegas, and they say it is constantly busy. So Vegas is an up and coming city again, and that's why I think Vici is going to do very well there. Then I've got my just regular ETFs, and these there's a lot of overlap when it comes to some of these plays here in the market. So I've got some, maybe over diversification, but it doesn't phase me at this point in my investing career. So I may consolidate at some point in the future, but for right now, I'm fine with it. I've got VYMI, SPYD, VYM, SCHD kind of offsets a bunch of these, DGRO, and that's more of a growth play. CGDV, and then VU, of course, just investing in the market itself. So I've got these plays here. Now, looking over to the side, I also have what the percent to my end game is. I've got what my percent of the portfolio is, so I can see how they're affecting my entire portfolio. And it's one goes down, it's not going to affect it all that much. I break down my dividends, I break down the monthly payouts, and then the yield. And so this way I can see, hey, am I investing in things that are going to be outpacing the market itself as far as yield right now? And then I also factor in dividend growth in the future, but there's so many different factors for that, I did not put it in my spreadsheet. So when it comes to the individual companies that I own, UPS I like. I don't think they're going anywhere. I know that they had the huge hit last summer when it comes to the deal that they made out with their union. So, they could see some bottom line effects from that, but, they're going to weather that storm and they'll come out of that perfectly fine. ExxonMobil, as much as I am a fan of the EV plays, and I think that EVs are going to be the wave of the future, Exxon's not stupid. They're going to figure things out, and they're going to be able to get into that and be able to adjust and make those things on the fly. So ExxonMobil, I think, is going to be great. AbbVie, that's health and care. Coca-Cola and Pepsi, these are the duopoly right here. There's a bunch of duopolies that I own, and I think they're great. Bank of America and JP Morgan, I wouldn't say it's a duopoly. There's a bunch of different financials out there, but JP Morgan is one of the best. Procter and Gamble, one of those plays that I like to have in case we get a massive pullback. It's weathered lots of different recessions and storms over the decades, so why not? Starbucks, I mean, with Taylor Swift out there being in the NFL, I'm sure there's going to be a lot of Swifties buying more Starbucks over the years, so it's not going away anytime soon. Home Depot and Lowe's, I have that another duopoly here because, again, Amazon is awesome, but they're never going to get to the point, at least as far as I can see, get to the point where they're going to be able to supply people with what Home Depot and Lowe's have when people need stuff right now. So Home Depot and Lowe's are going to be strong long term. McDonald's, you could almost call it a REIT. It's a huge real estate company when it comes down to it. So I love McDonald's long term. AVGO Broadcom just saw a massive pullback as everything was pulling back this week between that, NVIDIA, and a bunch of the other tech plays that are out there. But AVGO, I think, is going to be great. Probably going to end up splitting soon as well. Not to say that that's why I purchased this, but looking at the AI craze that's going on, I think they're going to be doing quite well. Cat, one of those industrial plays. Occidental, another oil play. Oracle is another play on the AI. And then the credit cards. People are always going to be using credit cards. So I got American Express, Visa, and MasterCard. Cintas is another one of those safety plays that I have because companies use them and they're one of the largest in the world. Microsoft, obviously, for its AI plays as well. Eli Lilly for the healthcare. Costco has been doing amazing. They did miss a little bit on their earnings, but they traded a premium. I'm going to just keep on adding to Costco over time. I think they're going to be great. And then, of course, I've got Apple, Meta, NVIDIA, and then Flynn. This is my ETF play that goes into India. I think India is one of those giant emerging markets that's going to boom over the next couple of decades and become basically the next China. And so this is a play and an ETF that goes based off of that. And so I've been adding to this position. I've done quite well on it. I started buying this at around $32 and it just keeps on going up. The dividend isn't huge on it. It just pays, there's like 1.3%. Let me see. Yeah, 1.34% for a yield. But, the growth that I'm getting on this is quite nice. And then, of course, my regular growth plays. I've got Google, Uber, Tesla, Amazon, SoFi. I think SoFi is going to do very well in the long term. So I'm just adding little bits to it. Now, Tesla, yes, I am down to 10 shares. I know, you get mad at me all you want. I'm down to 10 shares, but I have decided to sell some of this. And I sold a lot of it. Now, look at it. It's 175. I sold a lot at the $220 to $260 level. I made profits on it. You can't get mad at people for making profits. So I took those profits, I put them into other places to bring in cash flow because my thoughts on Tesla are that we are going to be higher for longer for interest rates. We are going to end up seeing Tesla miss for this quarter when it comes, I don't want to say miss, but they're going to have, weaker growth in the quarter over quarter numbers just because of what's going on in the economy still. So, and I think this is still going to affect them. Again, I think Tesla is going to be potentially the best company long term in the next 10 years. But for the next year, it's going to be a struggle. And I think I can get Tesla at a much better price in the future. And if I can take this money here, bring in cash flow to be able to buy more Tesla for a lower price, that is the gamble I am taking right now. That's just me. Obviously, I may lose some of you because of that. I may upset some of you, but hey, I'm doing what's best for me and my portfolio, and that's why I'm doing this. And then I've also got Palantir down here, which I need to add more to this position. I started buying at 10, sold some at, let me say it. I bought some at 10, sold some at 18, bought back in at 16. Now it's at 26. So I'm going to continue adding to this position. Then I've got my cryptocurrency. I've got Bitcoin, Ethereum, Doge, and Sheeb. These here, I just keep on. I've been trimming a little bit here and there. I know that we hit the $70,000 level for Bitcoin, got rejected twice already, pushing up again this morning on it. So I'm not sure if it's going to break through that. If it does, I think it's going to continue running, but nobody knows for sure. So I just wanted to trim a little bit off of my position as it was way up. I was up like 300% on some of these. So I trimmed a little bit, not much, put it into my other growth plays, and then I'm just going to continue to ride these. So overall, my portfolio total is $47,984. I do have $4,200 in a high yield savings account. So this here is also bringing in 4.6% interest. Real estate, I bought a house, as you guys know. So the equity that I have in that is $11,768. So my total portfolio is just under $64,000. And then I break down all the numbers here individually. You guys can feel free to pause this and take a look at all the numbers here. Some of the return numbers are off. I've got to fix my costs. I just haven't had time to go through all of that. I've been more concerned about making sure that I actually have the foundation set for growth on this as I want to see. And then I'll take a look at the actual returns that are coming in later because my focus has been more on cash flow. And so when it comes to the real estate, I'm looking to be renting this place out by July. So within 3 to 4 months from now, I want to get this onto the market and hopefully generate about $2,000 per month on this investment as well. So I call this my panic-proof portfolio because for me, my emotions get into trading a lot. For those of you guys who have been with me for a while, you know that I went through a lot of the emotions in the very beginning when it comes to Tesla, up and down. And I taught myself to not worry about the emotions when it comes to the sentiment in the market. And for me, when it comes down to the actual passive income plays, when it comes to dividend investing, there really isn't any emotion involved. Again, it's just kind of boring day-to-day stuff that I'm just constantly dollar cost averaging, playing some games, and I'll go over those with you guys in a minute to kind of, play, hey, where am I hitting these different levels along the way to get to my next step so that I'm continually growing my portfolio. And that's where I'm at. And so if we do get into a massive recession, because of how this portfolio is structured, I can actually buy more for less. Because when it comes to dividend investing, it's about quantity of shares, not share price appreciation. And of course, it's good to have both, but just like, the whole mentality of buy low, sell high, if I don't want to sell, I still want to buy low because buying low means I can accumulate more shares and get those dividends coming up. Now, yes, companies can definitely cut dividends, so you have to pay attention to things like that. But if you look back at the financial crisis, we still saw a lot of companies raising dividends through all of that, or maybe they just held dividends. Either way, they did not cut. So you still saw the growth in your portfolio. People were losing their jobs. Meanwhile, people who had dividends were getting raises. So it's kind of wild to think about, but that's what could potentially happen. So it's a very big downside risk mitigator when it comes to this dividend portfolio. But I also don't want to miss out on the growth. That's why I have the growth plays that are in there and I'm building those as well. And that's also why I end up having the dividend growth plays, because they will grow over time. So whenever we have these opportunities and we get big pullbacks in the market, I can take advantage of those even more by having that cash flow coming in. So if Tesla does end up pulling down, fills that 146 gap, fills that 114 gap, guess what? I have plenty of cash coming in to take advantage of that. I currently have my drip turned on, which is all the dividends I have coming in get rolled right back into that stock, except for my extreme yield plays. Those I do not. Those I use that cash to distribute as I feel necessary. But again, that's that cash coming in, and maybe I turn that drip off. Maybe if we hit a big recession and I really want to add to Tesla, if I want to add to Apple, if I want to add to Nvidia, if I want to add to Meta, I will have this cash flow coming in on top of my job, on top of my real estate income, to be able to put into the stocks that I want to be able to put it into. Having cash and cash flow gives you the ability to be agile and take advantage of opportunities. Whereas before, when it came to just my swing trading, I didn't have that opportunity. If the market was coming down, what was I going to do? I just sat there and had to just ride it out. I don't want to do that. I don't want to ride it out. I want to be able to take advantage of these opportunities, hence this portfolio. So I don't have to panic. I can now be excited when we get things that come down because, hey, I can now buy more for less and I have the cash to be able to take advantage of that. So that's why I created this panic proof portfolio for myself. Again, this is not financial advice. This is just what I'm doing for myself and why I created it, because it makes me feel better about myself and I can have this downside risk mitigation, but also have the ability to take advantage of any growth and runs that we have in the market that we've been seeing over the last 3 to 6 months. So thank you guys all so much for watching. I appreciate all of your support. Feel free to ask me any questions in the comments that you want. I'm an open book. I will share everything. I try to be as transparent as possible with you. So otherwise, thank you and have a great one.